Hi student, welcome you to our classes conducted by our YouTube channel, SL Accounts School. Today's topic is ratios. Ratios are important indicators and useful tools to interpret financial information for the benefit of various end users. Each of these ratios will have special and specific usefulness, but we will not be discussing at this class. There are three common usefulness which may be relevant to all ratios. Namely, comparing them with selected companies or comparing them with industrial norm or comparing the results of the company year to year. We will learn them in four classifications, namely 1. Profitability ratio, 2. Liquidity ratio, 3. Efficiency ratio, and 4. Investment ratio. Gross margin ratio is gross profit divided by revenue or turnover into a percentage. The next one will be markup ratio. Here again, the gross profit will be divided by cost of sales and into percentage. Profit margin ratio will be profit divided by the turnover into a percentage. Here the profit can be interpreted or defined in different ways. For an example, profit can be before the interest charged or maybe after the interest charged. Return on capital employed is where our net profit is divided by capital employed into a percentage, and here again capital employed can be interpreted differently, and then the profit also would be adjusted accordingly. For an example, if the capital employed is referred to as pure equity, then all charges such as preference dividend, interest to debentures, etc. will be deducted before arriving at the profit. Next one is expense to revenue ratio, that is expenses divided by turnover into a percentage. This can be the total of all expenses or a certain specific expense such as administrative expenses, distribution expenses, etc. The important thing is all these definitions are consistently to be applied. Next is under liquidity ratio. Current ratio, that is current assets divided by current liabilities, indicating the ability of the company to repay its liabilities. Next, liquidity ratio or acid test ratio or quick ratio, where inventory will be removed from the current asset, that being the least liquid asset, and compared with the current liabilities. Next is efficiency ratio. Non-current assets to turnover. That is net revenue divided by net book value of the non-current assets. Here the students should understand every time the non-current assets are mentioned, that is you just talking about the average. Similarly is 4. Trade receivable or trade payable or inventory. It is the average which is always meant. In the case of trade receivable to turnover, here only the credit sales will be taken into account. If this ratio is multiplied by 365 days in the year, it will give the average collection period. Similarly, trade payable, referring only to credit purchases and will be divided by turnover, is to arrive at the payable ratio. And if it is multiplied by 365 days in the year, it will give the average payment period. Next, rate of inventory to turnover ratio is cost of sale divided by average inventory. If this is multiplied by 365 days in the year, it will give the residence time or stock holding period of the inventory. Next is working capital cycle in days. Inventory of stock holding period in days plus trade receivable period in days minus trade payable period in days will give the average working capital cycle in days. This can be also stated as inventory to turnover in days and debtors to turnover in days and minus creditors to turnover in days. Next, working assets to revenue or net working assets to revenue. Inventory plus trade receivable minus trade payable divided by turnover into a percentage. Income gearing ratio is interest expenses divided by profit before interest paid into a percentage. Gearing ratio is fixed cost capital divided by total capital. In another word, fixed cost capital divided by fixed cost capital plus open cost capital. As shown below, non-current liabilities plus preference share capital divided by issued ordinary share capital plus all reserves plus non-current liabilities plus preference shares, etc. The other classification ratio is investment ratios. Students must note every time a share is mentioned, we refer to equity shares unless otherwise it is stated. Earning per share net profit minus preference dividend divided by number of issued shares. Next, the price-earning ratio is market price per share is divided by earning per share, which we worked previously. This may indicate how many years it might take for them to recover the investment by way of dividends. Next is dividend yield ratio. Dividend paid and proposed divided by market price per share. Origination will give dividend as a percentage of issued share capital. But here we are talking about the market price, which can be totally different. Dividend cover is profit available to pay is divided by the dividend actually paid. Dividend per share is similar to earnings per share. Here instead of profit, it is the dividend. Dear students, we hope you have understood what we have learned up to now. Now let's look at some questions. Out of the 4 options given, which ratio measures the business average credit period? Current ratio refers to the relationship between current assets and liabilities. B is about the relationship between inventory and turnover. Acid test ratio is current assets minus inventory compared with current liabilities. Therefore, the answer D, which refers to the average receivables over turnover, giving the payment period or credit period. The next MCQ, perusing the information given, you are required to calculate the number of days you take to pay your suppliers. Out of the information, credit sales, not relevant. Total purchases, not relevant. Total sales, not relevant. Trade receivable, not relevant. If you note the working 40 divided by 320 into 365 days, roughly 46 days, therefore the answer is B. The next MCQ is about current ratio and acid test ratio, and this can be improved. Option A and B will reduce the potentiality of debt collection and will not help. C is about inventory purchased on credit, therefore that acid test will become even tighter. And therefore the answer is D, where cash is brought from outside the current assets operation. The next question is a set of information given and 3 different questions are given. Question 1, working capital, that is current assets minus current liabilities. Question 2, current ratio, that is the relationship between current assets and current liabilities. Quick ratio is current assets minus inventory compared with current liabilities. Please look at the working. Working capital is $66,000, therefore the answer is B. Hi student, welcome you to our classes conducted by our YouTube channel, SL Accounts School. Today's topic is ratios.